And I think that if I'm right about what's happening with the de-dollarization process and the fact that foreign central banks are not just randomly dumping dollars and buying gold, they're doing it for a purpose. They want to back their currency with gold more than dollars. They want to make this shift in the composition of their reserves away from dollars and treasuries towards gold for a number of reasons, political, economic, all sorts of reasons, validate that transformation. If that is going to be ongoing, it has, I think, big impact on the emerging markets.
Gold and silver continue to demonstrate remarkable resilience, holding levels that would have seemed extraordinary just months ago. Gold remains firmly above $4,000 an ounce, while silver trades consistently above $51, signaling that the precious metals market is more than just experiencing a short-term rally. It is establishing a higher structural baseline. Even after recent peaks, with gold briefly surpassing $4,300 and silver climbing above $54, the pullbacks have been shallow, showing steady investor confidence rather than sharp corrections. Analysts, including Peter Schiff, emphasize that this behavior reflects a market actively finding new support levels and building momentum, suggesting that both metals are moving toward a more dominant role in the global financial system. Silver's technical breakout above a decades-old double top, combined with gold's ability to maintain elevated levels amid fluctuating markets, underscores the renewed strength of the precious metals sector. Peter Schiff has long argued that these metals would reclaim their historical importance as reliable stores of value, and current market dynamics appear to validate his perspective. Investors are increasingly recognizing gold and silver not just as commodities, but as safe haven assets capable of preserving wealth in times of uncertainty. The steady inflow of capital into these metals highlights a growing global appetite for tangible assets that retain intrinsic value, even as other markets face volatility and unpredictability. Institutional behavior further confirms this trend, as central banks worldwide reduce their exposure to US dollars and expand their gold reserves in response to rising debt levels and weakening confidence in treasuries. Leading financial firms, including Morgan Stanley, have also begun advising clients to allocate significant portions of their portfolios to gold, a rare but notable endorsement from mainstream institutions. According to Peter Schiff, this shift reflects a long-anticipated move toward tangible, durable assets, signaling a broader transition in the global financial system. With silver showing technical strength and gold maintaining persistent upward momentum, the precious metals market is increasingly positioned at the center of a strategic return to stability and enduring value. Now, we present the clips from Peter Schiff's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Metals held up really well. I mean, gold is still above $4,000 an ounce. In fact, I'm pretty sure it's pretty close. I'll check it to being back above 4,100. It's now 44,080. So it's holding above what would have been a record high, like a month or two ago. And silver is above $51. So, I mean, silver is above the double top that was massive resistance going back to 1980. Yeah, I mean, silver is off its peak because silver got above 54 and gold got, above, 4,300. Big buyers of gold as they've been divesting of dollars, which makes a lot of sense that, given the trajectory of our debt, it's clearly unpayable. And either we default or we inflate. Either alternative is not good. And so central banks don't want to hold U.S. dollars. So what are they going to own instead? Are they going to stockpile euros or Japanese yen or, Chinese RMB? None of those currencies look particularly promising either. They've all got their problems. But gold is, the only clean shirt that's not in the hamper with all the others. Gold is the best monetary asset for central banks to own because not only can it be created out of thin air by any central bank, but you don't have any counterparty risk. If you keep the gold in your own country, you don't have to worry about a default or, inflation. You've got the gold and, you can't be sanctioned, nothing. So that's a far superior situation than holding dollars and investing them in U.S. Treasuries to get a low yield, but also leave yourself vulnerable to the whims of the United States to yank your Treasuries out from under you whenever we decide that it's something that we want to do. So yeah, this is a problem for the U.S. government, and it's going to become a bigger problem as the bond market really starts to sell off and yields really start to back up, and the Fed is ultimately going to up the size of the quantitative easing. If it hasn't already started it started, and have to print more money to buy more bonds, and then the minute they do that, well, then they make the bonds that they don't buy that much less attractive. And so now more institutions, whether it's central banks or individuals, want to get out of their treasuries. Yeah. And now the Fed has to buy more, but that chases even more people out. So it's there's no way out of that spiral. I think that the losses will be particularly high against the emerging market currencies, and so that's going to deliver a lot of new purchasing power to consumers in those economies. And that's going to stimulate all sorts of spending because their money will go a lot further because their costs will be a lot lower relative to their own currencies that have appreciated. And I think that will also enhance the investment returns in those assets with currency gains. So I think more capital is going to flow in there. They're going to benefit from a more enriched households that can spend more and invest more. And, as they consume more of what they produce, they won't be loaning as much money to America, and therefore their savings will be invested more productively domestically than loaned out to the United States, to buy houses or whatever we're doing with the money. Yeah, and so I think this is going to benefit earnings in those countries, economic growth. Their stock markets are going to follow. I think it's like a big burden is going to be lifted because the lion's share of the burden of maintaining the U.S. dollar's reserve status has been borne by these central banks because in these emerging markets, because they are producing so much of what we consume. That's a massive subsidy. They're lending so much of what we save. So I think to the extent that they're no longer burdened with that, that's going to be like a huge weight lifted from their shoulders, and they'll be able to move around a lot faster and a lot more efficiently without having to carry us. America is going to be in trouble because now where are we going to get all our stuff, right? All the stuff that we now import, where are we going to make it? How are we going to buy it? I mean, that's going to be very challenging. The job that other countries have is not challenging at all. It's actually quite enjoyable. Just consuming what you produce, that's pretty easy. Yeah. And the methodology for that is prices come down. So, your currency goes up, and so your prices go down. And so more of what's produced in China stays in China, gets consumed in China. So the Chinese enjoy it, not Americans.
The U.S. government faces growing fiscal challenges as foreign central banks reduce their dollar holdings, leaving the Federal Reserve to absorb the remaining demand for treasuries. Analysts warn that continued money creation and quantitative easing to fund government spending could drive inflation higher and weaken the dollar, while soaring deficits, mounting national debt, and unfunded liabilities intensify long-term risks. Social Security and other trust funds are increasingly reliant on Treasury IOUs rather than direct tax revenue, highlighting the systemic strain. Observers note that official inflation and growth figures may understate the true economic pressures, masking rising living costs and potentially fueling further instability. Amid these financial pressures, precious metals are drawing renewed attention from investors seeking stability. Peter Schiff emphasizes silver as particularly compelling, citing its historical undervaluation relative to gold and its strong potential for demand growth beyond central bank purchases. Gold and silver remain reliable stores of value, offering a hedge against inflation and currency weakness. Schiff underscores that these tangible assets provide both security and long-term purchasing power in an environment where U.S. fiscal policies, debt accumulation, and inflation risks continue to challenge the dollar's strength.
I don't know how many rate cuts the Fed is going to be able to deliver, but I do think we'll have quantitative easing. But again, that's not a good thing. That's just more inflation. And it's just meant to prevent a collapse, but we end up taking our medicine in a different form. And I think it's actually worse. So it's not going to be a good thing. The Lisa Cook situation, I think that if the Supreme Court upholds Trump's right to fire her, I think that's a negative for the dollar and for a loss of Fed credibility. Because if he could fire Lisa Cook, they're pretty much going to say he could fire anyone he wants. That, it's really up to his discretion to define what cause is. And, if it's just because he doesn't like her policies, that's still going to work. Because it's pretty clear that he's not firing her because of the mortgage situation. The only reason they know about the mortgage situation is because they were digging for dirt, right? They were trying to find something on her that they could use against her as a pretext for putting, a lackey in her place that's going to vote the way Trump wants. But I think that's going to be problematic if the Supreme Court says that you could fire her, because they're basically going to say that an independent Federal Reserve is not even constitutional, that the Federal Reserve must be accountable to an elected body, that they just, there's nothing in the Constitution that creates a fourth branch of government. So if they're not a branch of government, then they're part of one of the existing branches, is what they might argue. And so they may give more power to the president to, oversee these governors and dismiss them if he doesn't like the job they're doing. So I think that could be a problem. And, the tariffs, we'll see what happens with the tariffs. I think that the tariffs will be struck down, and, they're obviously unconstitutional, whether they get struck down or not. But if the Supreme Court does a good job, then the tariffs are going to get struck down. And so the question is, how is the market going to react to that? I mean, it's obviously a positive in the sense that the tariffs are not good, but the tariffs were at least bringing in revenue, not from the rest of the world, from American consumers who end up, footing the bill. But that means we're going to have bigger deficits if we don't get that revenue. And, Donald Trump has gone out there and said, if these tariffs the Supreme Court overrules my tariffs, it's a disaster. We're going to collapse. I mean, turn out the lights. The country's over. So, I mean, to the extent that people believe any of that, right, then, there could be some problems. I think the markets would be more relieved by the absence of tariffs, because I don't think people believe what Trump is saying about how vital these tariffs are to our national survival. But they will cost the government revenue. So if they're not going to get revenue from tariffs, where are they going to get it? Right? We have massive deficits as it is, and they'll be even bigger absent the tariffs. Well, I mean, Trump just threw that out on a social media post at some point. So there are no real tariff dividends. It would be the equivalent of just more stimmy checks that they would be sending out. But Congress would have to appropriate that money. So Trump just can't direct the tariff revenue to households. Congress would have to approve that. Now, they may get that through because no one's going to want to stand in the way between a voter and a $2,000 check. And especially, the way Trump proposed it, it's per person, not per family. So a family of four would get $8,000. Now, of course, most of that money isn't even going to come from the tariffs because the tariffs aren't bringing in that much money. So, they would just come out of the general revenue, which means you have to add to the deficits because we don't have the money. But even if, some of the money is offset by the tariffs, it still adds to the deficit because otherwise the tariffs would have subtracted from the deficit. And if we don't get the subtraction because we've just mailed out these tariff dividend checks. But of course, the biggest fraud of the tariff dividend checks is that we're giving the tariffs back to the people who are paying them in the first place. So they're not really getting a windfall. They're just getting their money back. Now, some people might get a windfall because they may not have bought that much stuff. And so, they may win at the expense of somebody else who loses on the deal. But they also defeat the very purpose of the tariff. If the tariff is really there to discourage imports by raising the price of imports, and so we don't buy as many imported products, if the government just hands everybody a check, now they have more money to pay those higher prices. So we end up subsidizing consumers to buy the items that we tariffed. And so now they don't reduce their imports. They just keep on buying. So we don't accomplish any, insourcing of our manufacturing. That only would theoretically happen if consumers balked at paying the tariffs. But if we give them a bunch of money, then they can afford to pay the tariffs. So it really makes no sense. But it shows that Trump doesn't even understand the policies that he's promoting.
Gold and silver are showing strong potential for continued gains as economic pressures in the United States intensify, with rising deficits, declining foreign purchases of treasuries, and persistent inflation concerns driving investors toward tangible assets. Gold is expected to maintain its role as a central store of value, supported by steady demand from both central banks and private investors seeking protection from currency devaluation. In contrast, silver, historically undervalued relative to gold, stands to benefit from increased recognition of its scarcity and industrial applications. As inflation pressures mount, capital is likely to shift further into precious metals, creating sustained upward momentum, with silver potentially seeing notable gains as the market responds to combined monetary and industrial demand. Over the coming years, these dynamics suggest both metals could not only hold their current levels, but also reach new highs, reinforcing their position as essential hedges against economic uncertainty and currency risk. The question now is, will this trend continue, and could gold and silver surpass previous historical highs in the next major financial cycle? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.